Jeremy Siegel, professor of finance at Penn's Wharton School, joins us this morning to discuss. Professor, great to see you. I want to get to the Q4 playbook, but I am curious about your views with what we've just been discussing, and that is this separation between the movement in yields versus inflation products, break even. Do you think that's largely technical? And if so, how much can it get reversed?
Well, I think the economy is still very strong. I mean, take a look at this ISM report. It certainly was above expectations. I mean, estimates of third quarter GDP are north of 3.5%. I mean, some like the GDP now are even north of 4%. I think this economy is cooking. I know economic surprises, some of them have been negative, but on the whole, we have a strong economy. And of course, the rising oil prices, which is really a supply shock because OPEC is, I think, at a record restriction from their capacity. Don't forget, bondholders look at overall inflation. They don't just look at core inflation. Core inflation might be doing good. Yeah. Overall inflation is going to be affected by those oil prices. So, I think that the higher yields, that's what's been pressuring the equity markets. I think the recognition that, hey, what happened last year, bonds not being the hedge that they had been for 20 years against stock declines has sort of dented. Do you want bonds in your portfolio when inflationary episodes are likely to be more frequently in our future?
You can't say that bond yields are rising because the economy is strong, because it's not strengthening. And a big part of the move has just happened in the last few weeks, Professor Siegel, where the economy, while coming from a strong base, is weakening, not strengthening, right? So there's something else going on.
I'm not, as I say, the third, we just started the fourth quarter, of course. Third quarter is going to be north of 3.5%. We're going to get positive payrolls again. What's happening is a rebound in productivity. Remember, 2022 was the worst productivity, I think, that we had in 75 years. And what we see is a rebound in productivity. And, of course, the expectation that AI may perpetuate that rebound in productivity into 2024. So we don't need blowout payroll growth like 250, 300,000. We can have 150,000 and still have GDP growth above what we've had for the last 2-3 years. So I think that the economy is strong enough. I think that the core inflation is going to be stubborn. But let's face it, the Fed, has to look at what's happened to the yields, and that has affected home building. No question, housing starts were down. Home building sentiment in the NAHB index has fallen quite a bit in the last 2 months. And as you guys have all mentioned, we're getting 30-year fixed mortgages, no-point mortgages that are, beginning to move towards 8%. That's got to have some depressing effect. But other than that, when you look at jobless claims, 200,000. Wow. That's one of the first indicators to really show weakness on the real side. I don't see it yet.